I'm Martin King. I'm the property analyst at Edison Investment Research, and I'm joined this morning by Stephen Ingles from Regional REIT. Stephen is Chief Executive of London and Scottish Investment Management, which is the asset manager to Regional REIT. He also sits on the board of Regional REIT as a non-executive director. Stephen, good to see you again.
Good morning, Martin.
You've just reported half-year results to June 23. It's been a challenging period, which has been reflected subsequently. Could you start by giving an overview of the first half?
Sure. I think we need to look back into 22 to understand what's happened in the first half of 23. So let's split it in two: the capital element and the income element. Clearly, we are an income stock. We came to market with an intention of paying as high a dividend level as the net income could sustain. I think we've successfully done that since 2015. Now, clearly, our income level is down, and therefore dividend level comes down with that. I don't think anybody would, in the current climate, thank us for paying an uncovered dividend, and therefore dividend levels have to reflect net income levels. So why are net income levels not at the consensus forecasts of the analysts? So a few factors play into that. During 2022, as previously reported, we had a record lettings year. Obviously vacancy had fallen subsequent to the pandemic. And of course, we forget we're only recently out of the pandemic. But income did fall. Gross and net income fell during the pandemic. Occupancy fell, and therefore, naturally, as we were beginning to see a small recovery in 2022, the letting story was very good. Now, that continued right the way through 22, and we anticipated that would, in fact, that momentum would be continued into 2023. Then, of course, we had the Liz Truss debacle and the vast interest rate movements, which of course hit our capital values as at December. However, at that stage, it didn't impact lettings. So despite the fact in October, Liz Truss and her merry men decided to go on a radical change of economic policy, that clearly impacted interest rates. And to a certain extent, the inflationary pressures were not curbed. But sitting at December last year, most economists were predicting that interest rates would stabilise, and indeed that inflation would begin to come down over the course of 2023. Of course, that never happened. Stubbornly high inflation and continuing interest rate hikes by the Bank of England. And that's had a major impact on decision making. All businesses are impacted by interest rates and inflationary pressures. And what we found is that decision making effectively froze. So those companies who could defer making a decision on a move decided they would. CapEx projects were on hold, and of course, moving office is a big CapEx project. So the letting activity was down. In terms of income, half of what it was in the 6 months to June 22. Nonetheless, we did 45 new lettings and for 1.2 million of new income. As I say, far, far lower than we anticipated, but nonetheless, very encouraging. And more encouraging, those lettings were on average at 13.5% above ERV. So what does that tell us? That tells us we've got no mass oversupply situation. Vacancy rates across the country remain relatively low, and therefore that supply-demand dynamic is okay. We just haven't seen the rate of lettings we anticipated. The second thing to bear in mind in terms of our income, vast majority of our income, of course, is rental income from tenancies. But a portion of our income is also down to dilapidations claims and other things such as surrender premiums, where a tenant hands back their property and pays us the equivalent rent rather than continuing to occupy. So that always makes up a proportion of our income every year. Now, of course, coming off the pandemic, many people gave up their offices. They thought they were going to be working from home, more of which I'll discuss in a minute. But that happened. People gave up their leases, and therefore we had dilapidations payments made and surrender premiums paid. and it was slightly higher in 2022, given that 2021 into early 22 scenario, than it would normally be. Things have stabilized this year, and we're back to a more normal year, given occupancy continues at 76% renewal rate rather than the 60% we had in the pandemic years. So all of that has impacted income, and of course, not pleasing for anyone, but gross income has held up comparatively well. Net income's been impacted really for those factors. We renew always 70% plus, 76% in the first 6 months. That tells you that people are deciding not to move, slightly higher than normal, which you would expect to see. And also, that holding vacant property costs money. For every pound of rent, there's £1.85 to the bottom line. Those costs have increased substantially during the last couple of years, down to inflation, and in my view, also a bit of profiteering by suppliers and providers. But nonetheless, costs have gone up substantially. And the way you deal with that is only, you have to reduce voids. That has two impacts. One, clearly the savings in terms of the hold costs, but also rent. And you reduce voids in two ways: one leasing and one selling voids. And we were doing both. If I touch on the capital just for a second, clearly we at the full year were sitting at, having had a 15% decline in values over 2022, we were sitting at the high 40s, 49% LTV. Now, that is not a high level. 50%, 55% is not a high level in the property world. However, it is in the investment trust world, and we fully recognise that and agreed that we would address that. And the long-term target of the board is 40%, and that remains the case. We're committed to getting LTV back to 40%. Now, we did start selling assets. We sold £14 million of assets in the first 6 months at value, and did repay debt with those proceeds. One portion of debt repaid just before the half year, 7 million. A further 5 million has been repaid since the half year. But of course, we then got hit with another downward valuation as at June, down 3.8%, which comparative and relative to the market is actually okay. I mean, the market's down over 7% for regional offices, so we've outperformed the market to a degree. And that's really down to our asset management initiatives undertaken over the period, which normally would add value. In this case, it's just created a situation where there hasn't fallen in value in the same way that other assets would have. So that's very disappointing. Again, reflection of interest rate movements. Valuation seems now to be intrinsically linked to interest rate movements. It shouldn't be, in my opinion, because it doesn't allow for rental growth. And that rental growth aspect is very, very important. But nonetheless, valuation is valuation. We're down 3.8%, and therefore that's pushed our LTV up slightly, despite the fact we've repaid some debt. So we're now sitting at 51.9%.
Stephen, with that in mind, can you say a little bit more about your plans for bringing down loan to value, and also what the implications for income might be as you do that?
Sure. I mean, in the current climate, Martin, we cannot be reliant on market conditions improving. We suspect they will, but that we cannot rely on that. Therefore, we have to take matters into our own hands. And the only way to reduce LTV is to sell down assets and repay debt. Now, clearly, we'll be targeting the assets with least income, because income remains a vital strategy for the fund. And indeed, we're committed to retaining as high an income level as we can. So we'll be selling voids on the whole, or low income producing assets, repaying debt, and using an element of those proceeds for capital expenditure. Of course, we have to continually invest in our portfolio to improve the portfolio and improve income. But yes, we're very conscious of dividend and intend to maintain as high an income as we can, and therefore as high a dividend as we can. But nonetheless, the 40% target is there. We will sell down in a balanced and sensible way, whilst maintaining as much income as we can.
Stephen, how quickly do you think you can achieve sales? It's a difficult market. Past sales on a large scale have been portfolios, and I would imagine this is quite granular, stock property by property. Could you talk about that?
Sure. I mean, you're right. It is granular. It is property by property. But we do have, despite the fact the market is not in a great shape, we do have an active market, particularly in the 0 to 5 million lot sizes. That market tends to be localized, tends to be equity heavy, not reliant on debt in the same way as others. And indeed, alternative use value and alternative use of assets at that level is quite active. So that 0 to 5 million market active, 5 to 10 million, there is some activity. And the 10 million plus market is really where the issues come in terms of that market tends to be more debt reliant, as a consequence of which it's very patchy just now. But the 0 to 5 million market, we see some success. The assets we've sold to date this year have on the whole been vacant. You'll see the figures in our half-year results, a 2.8% income yield, which tells you the vast majority of it was vacant, and mostly for alternative use. So people buying perhaps partly income producing assets with a view to obtaining planning consent for change of use, or vacant indeed for change of use. And that tends to be for beds of some description, hotels, student accommodation, residential to lease or residential to buy, nursing homes, a nursery bought a small building that we have, and indeed industrial continues to be quite an attractive proposition for developers. So our business parks, of course, as to industrial development. So no lack of opportunities for us to sell into. But yes, it's granular, and of course, anybody doing the arithmetic can work out that to get to 40% LTV, assuming no further improvement in market and assuming no asset management initiatives, we need to sell roughly £150 million worth of assets. Now, that is a lot of assets, especially if the average lot size is going to be sub 5 million. Of course, it will be a combination of 0 to 10 million assets. But nonetheless, we have our target in mind. We will be selling in a strategic, balanced way, an aim really to get to that low LTV before we require to refinance debt, which is 2026. So that will be the timeline in which we'll be looking to rebalance the portfolio and bring LTV down to 40%.
As you say, selling low rent properties has the benefit of saving on costs, and also you have properties to let. So there's the possibility to raise income, the possibility to cut costs. In setting the dividend at this level, what is the board looking at for future dividends?
Yeah, I mean, the 5.25p targeted this year. I mean, we're sitting in September. Obviously, December is our year end, so we've got good visibility on income for this year. So 5.25p this year. The consensus forecast of the analyst is 4.8 pence next year. Now, the board have not cut dividend. I mean, the dividend has reduced, but that's reduced in line with earnings. So it's the earnings that drive dividend levels, not some board decision that we should set a dividend level at a certain level. We're a REIT. We have to pay out a minimum of 90% of our income. We've traditionally paid out higher than that, 95, 96, 97% of income, and will continue to do so. But yes, I mean, clearly 4.8 pence consensus forecast going forward looks a relatively low level compared to where we have been. And therefore, I think it's a reasonable assumption that is sustainable, and we can grow that dividend from that level in the short to medium term, assuming the market begins to show some signs of recovery.
As well as selling properties, you are also investing in them, improving the quality of the properties, their appeal to tenants, particularly in terms of environmental credentials. Can we move on to your plans for CapEx?
Of course. I mean, we continually invest in our assets and have done since we came to market. Capital expenditure is driven, as you rightly say, to improve assets, to make them more attractive to occupiers, to increase income. I think perhaps sometimes we get lost in the EPC and the ESG world, whereby EPC clearly has regulatory requirements that we've got to get to B, grade B by 2030. And of course, everybody's focused on doing exactly that. But that's not the fundamental reason for doing it. The fundamental reason for doing it is to improve the assets, to make them more attractive, to get more income. And we continue to do that. And CapEx for us tends to be 10 to 15 million pounds per year, depending on which projects are up. But that's a reasonable average over the market since we've come to market. And that will continue. And that CapEx will be covered by sales. So as I mentioned earlier, sales will go to repay debt, an element for CapEx. So these will be funded. Also worth bearing in mind in terms of CapEx, those figures are baked into the valuation. Valuation numbers start gross, so valuer values the assets and starts at a number. Then they deduct their view on CapEx requirements for assets to arrive at a net number. So the valuation quoted in our results is the net figure. So the CapEx has already been allowed for. I think there is some confusion in the market sometimes because the press cover this and say the industry will need to spend £1 billion on upgrading for the sake of EPCs, and that may well be true. I mean, where they pluck these numbers from, goodness only knows. But certainly in our case, that is already baked in, already factored in, and would be dealt with in the normal expenditure. I mean, for example, our valuation at the moment has just over 40 million of capital expenditure that the valuers have put on that. But we're spending 10 to 50 million pounds a year. So far, far more than that by the time we get to 2030. And a lot of that expenditure, of course, isn't landlord expenditure. Some of that expenditure is tenant expenditure. Tenants often spend money on their assets or the assets they occupy, and that is part and parcel of the overall capital spend. The other element is some capital spend is service charge. So again, there is no hole. So whilst they've allowed 40, we may well spend more than that. That'll be recoverable from tenants in some cases through the service charge. And others will be actually expended by the tenants themselves. So the overall CapEx on a building is not always landlord CapEx.
See, many investors remain cautious about the office market. You've already said that you're seeing no evidence of oversupply, but can you talk more generally about where you see the office market going?
Yeah, I think let's start from where it's come from. I think it's probably a good point. I mean, we have published a number of data points over the last year or so, which have gone largely ignored, I think, by the market, certainly by the press, because secondary regional assets aren't sexy. It's not HSBC Tower and Canary Wharf or whatever the case may be. But nonetheless, very, very important to the overall office story, in particular regional offices. So let's go back to March 22, the end of the pandemic, if you want to call it that. At that point, only 30% of our occupiers were back in their office in any shape or form. And at that point, we didn't know whether that was one person or 100 people. By November of last year, that was 99%. So a massive movement of companies recognizing they need to be back in the office. Big issue for companies and continues to be getting their staff back into the office. And that's an ongoing process. But that was November. We then undertook the largest study of offices and people yet done in the UK office market and published those results in April. And that was a study of over 100 buildings and over 24,000 people. So a very good sample size, in my opinion. And what that found was, at that point in time, companies had been successful in getting some members of staff back, and to the extent that 95% of pre-pandemic levels of occupancy were being achieved. So pre-pandemic occupancy, people were in the office. We're getting back, as at March and April this year, to 95% of that level. So those people were actually back in the office. And perhaps even more encouraging from an office landlord's point of view, and particularly in the regional markets, they were back for an average 4.2 days a week. So I think flexible working is here to stay. I have no doubt of that. I think once you have given people flexibility, or given something, in this case flexibility, very hard to take it away. But it looks like being, the model in the regions looks like being, 4 days in the office and 1 from home. Still developing, still not a stable market in terms of occupier market. Companies really only just having people back, so they'll test different ways of working, different methodologies, and then end up with what works for them. So maybe I'll change again, but I think the anecdotal, well, I'd say anecdotal, the actual study and other anecdotal evidence suggests that companies want their staff back, and they're trying very, very hard to get them back. That's very encouraging from an office landlord's point of view. So the occupancy story is strong. What we need is some stability in interest rates and inflation beginning to come down for people to make decisions. And those decisions, in our case, is the capex required to move office.
Within the overall plans to reduce debt, the only near-term debt maturity that you've got is the retail bond. Could you just say what your plans are for that in particular?
Of course. The retail bond's up in August 2024, so still some time away, but we have been, of course, looking at that for some time in terms of forward planning. Number of options open to us. We could issue a new bond, but obviously bond prices have gone up. Current pricing on our bond is 4.5%. Current pricing suggests that if we were to issue a new bond, for which there would be demand, but demand at 9 to 10%. So clearly interest charges far higher than current levels. Nonetheless, the bond is only 50 million. So the impact on earnings isn't as dramatic as otherwise would be. Clearly, we can repay the bond. We could sell down assets and repay the bond, but that would mean selling at a much quicker rate than we really want to. So we'd need to sell over 100 million of assets to repay that 50 million pound bond. On the basis that obviously our other assets are encumbered under our senior debt facilities. But all of these things are being investigated and looked at, and we hope to come back to the market and let the investors know the intended route prior to the end of this year.
Investors too are looking towards that peaking in interest rates. So for now, the whole sector is under some pressure. Perhaps you could just summarize by giving your view on what are the key messages that you've given are being overlooked.
Yeah, I think our story is very simple. We need to reduce costs. We'll do that by leasing vacant properties and by selling vacant properties, combination of both. The sales, of course, is double whammy because we'll then reduce our LTV. So our message is very simple. We're very focused. We need to reduce it. We need to reduce LTV. We need to reduce costs and increase income. And that's exactly what we're focused on doing. Now, I think there is a lag, and I've said this many times, that my belief is the office market would stabilise the end of 2023 and into 2024, really just down to what I've just been talking about in terms of the return to the office and perception of the office. I think that perception has changed in most occupiers' views, probably not the investment world. The investment world still reviews offices poorly, and that's reflected in the discounts for office landlords, particularly Derwents and ourselves at 50% plus discount to NTA. And I think that's unjust. I think there is almost an element of yesteryear in that assumption. To look forward, and that's what we're all focused on, looks very positive. Barring any other major economic disaster, but of course we can't rely on that anytime soon, given what's happened over the last 5 to 10 years. But I think if you look at things logically, supply and demand are in balance. Demand we expect to increase, and therefore that should be good. That I stated the stats earlier in terms of good renewal rates, and whilst the leasing market has been slower, nonetheless those lettings we have undertaken have been that whopping 13.5% above ERV. Real rental growth beginning to come into the market. And that's a great driver of performance for a property company.
Thank you very much, Stephen.
Thanks, Martin.